Hey everyone, welcome back to Corporate Decoder. Today we are diving deep into Owlet's financial report. Get ready because things are about to get interesting and maybe a little bit bumpy. We're looking at Owlet, the company that makes those smart baby monitors designed to give parents peace of mind. They've just released some updated financial information and we're going to break down what it really means for their business. Let's jump right into the numbers. As of the end of March 2025, Owlet had about $16.3 million in cash. That sounds like a lot, but when we look at their liabilities, especially current ones, which are debts due within a year, they had around $40.7 million. This is a gap that makes you raise an eyebrow. Their accounts receivable, essentially money owed to them by customers, was about $16.5 million. This is important because it speaks to how quickly they can get cash in the door. Now, for the cost of making their products, that was up to $9.8 million for the first 3 months of 2025. When you compare this to their total revenues of $21 million, it means they're spending a significant chunk of their income just to produce the goods they sell. Their gross profit, which is what's left after the direct costs of making their products are subtracted from revenue, was about $11.3 million. This is a crucial number because it shows how much they have left to cover all their other business expenses like marketing and salaries. Speaking of those other expenses, general and administrative costs, which include things like salaries for the executive team, legal fees, and office expenses, were $7.1 million. That's a huge piece of their gross profit gone. When you put revenues against all their operating expenses, including making the product and running the business, Owlet reported an operating loss of about $2.7 million for that same period. This means their core operations are not making money right now. And then things get a bit more complicated with the common stock warrant liability adjustment showing a gain of $6.7 million. This is an accounting adjustment related to the value of warrants, which are essentially options to buy stock in the future. While it looks like a gain, it's not cash in hand and can be very volatile, swinging wildly from period to period. For example, in the prior year, they had a gain of over $9 million from this, showing how much this number can fluctuate. After all those adjustments, they actually reported a net income of $3 million. But remember, a big chunk of that came from that volatile warrant adjustment. This translates to a basic earnings per share of 11 cents. Without that warrant adjustment, their picture would look quite different. Looking back at revenue, it's good to see an increase. Revenues jumped by over 43% compared to the same period last year. That's a significant jump, showing demand is growing. And their gross margin improved to over 53%, up from around 44% the previous year. This is a big win. It suggests they're getting better at managing their production costs or perhaps selling higher margin products, which is great for the bottom line. But let's look at the balance sheet. Total current liabilities are now around $52.8 million, a notable increase from $36.4 million at the end of last year. This means they owe more money in the short term. Their line of credit is also significantly higher, at nearly $15 million compared to just over $6 million. This shows they're relying more on borrowed money to keep things afloat. And then there's this huge number for common stock warrant liabilities, over $51 million. This liability also more than doubled, which is a red flag, indicating these warrants are becoming more valuable, likely due to an increase in Owlet's stock price, but it's a debt on their books that needs to be managed. Their accumulated deficit, which is the total losses the company has incurred since its beginning, now stands at a staggering $302.8 million. That's a lot of red ink. For the first 6 months of 2025, they used over $8 million in cash from their regular operations, which is more than the $6.7 million they used in the same period last year. This means their core business is burning cash faster. On the financing side, they brought in almost $10 million, but this was largely due to borrowing more money, not from operational successes. Interestingly, Owlet operates as a single business segment. This means all their activities are tied together, making it harder to pinpoint where specific successes or failures are coming from. Looking at their net income or loss, it's been a wild ride. After reporting a profit in the first quarter of 2025, the second quarter saw a massive net loss of over $37 million. This huge swing is largely driven by those volatile common stock warrant liability adjustments, which went from a gain to a huge loss in just 3 months. It's a stark reminder that accounting gains and losses aren't always real cash in hand. One of the biggest risks they highlight is that if sales drop, they might not be able to cut costs enough to keep growing. This is a classic catch-22 for companies trying to expand. The filing also repeatedly points out they have recurring operating losses and negative cash flows since they started. This is a major concern for any investor as it raises questions about their long-term viability without continuous external funding. A significant event mentioned is an agreement made in August 2025 to exchange warrants for shares of common stock. This involves some key stakeholders, including entities connected to board members. The goal here seems to be simplifying their capital structure, which is a good move given how complex it has become. The special committee, made up of independent directors, recommended approving this exchange. This is a good sign that the deal was scrutinized for fairness. This exchange requires stockholder approval, and it's crucial because it involves issuing a large number of new shares, which will dilute existing shareholders. And in a move to attract and retain top talent, they're proposing to amend their charter to shield officers from personal liability for certain breaches of duty. This is fairly standard practice for public companies, but it's good they're being transparent about it. While they state their current leadership structure is working, there's a subtle mention that the CEO plans to transition to executive chairman in October 2025, with the president taking over as CEO. This sort of leadership change can signal a shift in strategy or a response to performance. To sum it all up, Owlet is in a tricky spot. They're showing revenue growth and improving gross margins, which is positive. However, their operational losses are significant, their debt is rising, and they're heavily reliant on external funding and accounting adjustments like warrant liability changes to show any profit. The core business is still burning cash, and the going concern warnings are present. The warrant exchange is a strategic move to simplify things, but its success hinges on stockholder approval and the actual impact on dilution. This company is playing a high-stakes game, trying to balance growth with profitability and a complex financial structure. While the demand for their products seems to be there, the path to consistent profitability looks challenging. They'll need to execute flawlessly on their product innovation and cost management to truly turn things around. Now, what's your take on Owlet's latest financial report? Do you think they can navigate these challenges and achieve sustainable growth? Let us know your thoughts in the comments below. If you found this deep dive helpful, please hit that like button as it really helps the channel, and subscribe for more breakdowns of corporate filings. And don't forget to join our Discord community linked in the description for more in-depth discussions. Thanks for watching, and we'll see you in the next one.